Good afternoon, or good evening, or good morning, depending on when you catch this. I am Doug Lennick. I am here with Adam Recker, as usual, our Senior Managing Director for Head of Equities. Today, we're going to be talking about retirement income, which of course also gets into bonds. And I can assure you that Adam is an expert at all things bonds and equity. So we're into both. And Adam, I got to say, um, today I'm particularly interested in this, being of retirement age myself. We're actually talking about income now during retirement, not later. And, my first question to you as we kick this thing off is what should people who are thinking about that now, what stands out to you for retirees or people who are actually looking for income? What stands out now?
Yeah, I think there's a couple of noticeable things, and maybe as we talk about them, we can flip to the next slide just to be prepared. But I think the good news is that when we're looking at things like income, there's multiple choices we have to make. One, there's choices around what opportunities are out there. Are they good opportunities relative to history or not? We have to confront the possibility of volatility in returns and income and make sure that we have a plan in place that allows us to ride out the volatility and account for different stages of retirement, especially the earlier stages, um, and make sure that all those different factors are well aligned with an overall plan. And so I think,
Well, and that
sorry.
really relates well to the whole notion of smart money moves and the philosophy that we have here at the Mather Group. So you could even comment on that, and I guess you are.
Yeah, absolutely. And as we go through this, there will be some very, I think, tangible visuals that discuss even like a bucketing approach and how do you think about different stages in retirement and the right place to pull from. And so on the next slide, actually, kind of jumps into some of the opportunities, the main building blocks of a portfolio in many cases, bonds and stocks. And so I think naturally when people are thinking of income, they're thinking of dividends often from stocks or interest payments, but often bonds because there needs to be an area of safety in many portfolios, as we'll show, to be able to ride out the inevitable storms in the market. And so, because we haven't shared it before, thought it was interesting for this conversation. But stocks and bonds have volatility, and there's different metrics to measure volatility in the market. And so, one is this, ICE B of A Move Index, which just like the VIX for equities, looks at volatility in the bond market. And what's kind of noticeable about it is that bonds aren't absent from having volatility as well. They tend to be safer than stocks, but they don't always stay stable. We've seen the financial crisis, even periods before that, and even periods of heightened volatility, like the period in 2020. They can have drastic moves at times. More encouragingly today, though, they have been more stable and are at actually lower volatility levels than we've seen in some time, meaning that bonds feel pretty stable, and the interest that they're paying, we think, is expected to be pretty stable as well.
Well, and if somebody happens to own a bond, its value is changing, but that interest rate is fixed. So when somebody uses the term fixed income security, they really mean that. The income is fixed and it's a security,
Yeah,
which means the
absolutely.
valuation of the security goes up and down.
Right.
And sometimes people just miss that point. So my income doesn't go down from my bond even if my bond value went down. I don't have to sell my bond then at that time either.
Right.
And I
It's
would,
it's absolutely. It's can we wait out the storm, get paid back? Are the bonds essentially money good? If they are, income is consistent. We just want to
yeah.
make sure the bond is safe. And so, luckily, right
So,
now though, the volatility itself has been low.
well, and I think that you're looking at volatility, and volatility is one of the factors that people concern themselves when it comes to risk, but what are some of the core risks that retirees should be focused on?
Yeah, I think again, it's a little bit later in the discussion. We'll touch back on it again, but there's always risks in making sure, make sure we're taking on appropriate amounts of risk. We haven't been lulled into a false sense of security and taken on more risk just because the times have been good. We have to be disciplined in our approach. We need to make sure that we have fallback plans in case we run into market adversity, and make sure that the entire plan is integrated, not just the portfolio management in isolation, but make sure it's well integrated with the overall plan and things we can control like taxes. And so not losing sight that we need to stay consistent.
Well, and I think what you're hitting on, Adam, is truly the philosophy of financial planning and the whole focus that the financial advisors have with that focus on planning. So what we're really preparing for are all these things that you're talking about, volatility being one of them, but taxes, as you mentioned. So when we start to integrate those things in, what we're really looking at is a plan for that retirement, and we're not betting so much on predicting what's going to happen. We're just going to be prepared for it.
And so I think as part of the preparation, flipping to the next chart too. I mean, we talked about bonds a little bit and the volatility there. It'd be remiss not to talk about volatility in the stock market too, because that tends to be more noticeable to many investors. And what we see is that when we look at past periods of volatility, the VIX reading measuring volatility at very low levels, below 11, 12, even below, say 15, 16, 17%, generally low volatility environments, returns tend to be pretty good. Those tend to correspond with strong bull markets. However, in periods more similar to where we are today, and this isn't meant to create fear or anything like that, because volatility can rise today, it can be down again tomorrow. But with a reading of say something like 20%, that starts to be an environment where the market is kind of trying to figure out what's the next step. Is it higher? Is it lower? And as market participants are trying to figure that out, there can be more volatility overall, and that can lead to lower returns either by capping some of the upside or leading to periodic drawdowns, given that level of fear. And then looking even further out at more extreme periods where you see really high volatile environments where you're above 25, 30, 35, you can kind of take solace in the fact, in a sense, that those opportunities, that volatility actually tends to lead to better returns in the future long term. Not because it means everything's going well. It's often because there have been major pullbacks, but being disciplined and buying into the market systematically in a controlled manner when there are heightened levels of fear and perhaps stocks are on sale can lead to much higher returns over the long run too. And so,
well, and truly, that's what you and your team do exceptionally well. And the whole concept, and for everybody listening, one of the things that we find to be true, once people begin to realize they are prepared for what's happening, that what Adam and his folks have done is actually prepared for these possibilities, that tends to reduce that level of fear, such that whenever you need money, if you need to put your hands on some money, there's a smart place to get it. And that's what they are planning for in this whole process. So I think that's a reasonable time to comment on that. So thank you for that.
Let other market participants be afraid. We don't need to, because we have a plan. And so,
yeah.
Going to the next slide, even again, kind of circling back to the bonds, kind of mentioning there are options out there. So we know stocks can be volatile; they provide upside. We'll see that again here. We'll circle back on a few topics throughout this, but for those that are more risk adverse, are savers, rates aren't quite as high as what they were, say going back to the 80s or the 90s. We've been kind of in this lower interest rate environment, but compared to the most recent years, rates are actually at a healthier level than they've been in some time. And so not expected to provide the same upside as risky assets like stocks over the long run, but you are being paid some form of compensation through a more acceptable yield that is still higher than what you get from or lose via inflation. And so there are alternatives out there in that you can be paid to save, take on less risk, and a portfolio as a result doesn't have to work as hard as it did previously in close to a 0% rate environment, both for short-term bonds and longer-term bonds.
Yeah, and you're also using equities as well. So you're never out of the market really because you're really balancing all this off. And as retirees, sometimes what can happen, knowing a lot of people in retirement, is we can get scared about losing money. That loss aversion factor goes up, which is we talk about risk tolerance a lot of time in financial planning, but people tend to have reasonably high tolerance for risks that work. The issue is more often than not loss tolerance, and loss tolerance goes down, risk aversion goes up. What would you say about that?
Yeah, I think it's a good topic, just risk in general. I think that's one of the next ones on the agenda. So maybe we flip to that slide too. But yeah, it's being aware of the different risks out there. What are the things that can get investors in trouble? I think that loss aversion piece is always important to be aware of, where the pain of a loss is more severe than the pleasure of a gain, and so make sure that we can withstand those inevitable downturns. A very interesting one, sequence of returns is a risk. And I think many clients that have worked with us have become familiar with this, but thinking about why is it so important to have a smart place to pull money from? And it kind of comes down to the fact that when you retire, some of those early years can be more precarious if you don't have a plan or safe assets to pull from when a downturn happens. And so what this illustration essentially shows in a very, albeit simple manner, you take two hypothetical investors that have $1 million each. They have the same withdrawals they have to take throughout retirement. Essentially, they have the same market returns, but the key difference is the retiree that retires in a year that is strong, it doesn't have a market pullback, has sort of ups and downs in the market, they're pulling money out, but a retiree that's hit with an immediate downturn right when they started, and if they're forced to pull money out at artificially low prices and sell at artificially low prices because they didn't have a plan to kind of ride out the storm and control the risk, that can have a profound impact on the length of money or length of time that your money actually survives.
Well,
And
and the
so,
point you just made is so important for everyone to hear. If we do not have a smart alternative and we need the cash to live, we're going to sell whatever that security is at a reduced price. And that's unnecessary and can be avoided with planning. And I just wanted to highlight the point you were making there, Adam. Thank you. So sequence risk is a big deal, but can be handled through the balanced approach that we take.
I think, yeah, another risk would be, thinking about like even inflation. So on the next slide, it's a force that all of us are confronted with. We see it at the grocery store. We see it when we buy goods and services. For many of us that we expect to live hopefully multiple decades in a rewarding environment or rewarding retirement, inflation is going to be a constant force. And given that, many have to take on at least some element of risk in the portfolio to make sure they can not only keep up with inflation, but exceed it long term and be able to cover all of their living expenses, goals, and things that they have. To illustrate, some data going back to 1928 using the data set from NYU shows that inflation measured by CPI around 3%, let's call it, on average over the past X amount of decades, albeit not 3% every year, of course. But long term, it's been a constant force out in the market. Cash, and this isn't really cash like sitting in a bank account where it's earning nothing, but think more like short-term T-bills that can be used as cash equivalents earning something. basically right in line with inflation, best case scenario. Housing, generally a good inflation hedge over the long run, keeping up with that overall inflation rate in the market. Bonds, taking on a little bit more risk than just cash itself, entitles you to maybe a little bit above market return, but nothing that you would necessarily write home about in this environment. Gold has been a key topic lately. It's done really, really well in 2026 and 2025 to an extent as well. And so the numbers are looking increasingly good there. But it's noticeable that it still pales in comparison to something like large cap U.S. stocks measured by the S&P 500, which has been up roughly 10% over multiple decades. The catch is those stocks, again, are very volatile at times. They are prone to large drawdowns. And so there are trade-offs and risk discussions that have to take place because the only way to get those higher returns and, again, exceed inflation is to take on more risk. But we have to be comfortable with the risk and prepared for it.
Well, in previous show, I know we talked about making sure that people would be able to be invested during those important days, because if we miss those opportunities, we miss the gains. And again, it gets back to being prepared for the truth, and the truth is uncertainty. So one of the things we plan for is not knowing for sure what's going to happen. So Adam, as we think about all these risks and different strategies people can have, what are some strategies people can take and kind of put into play today in today's world?
Yeah, so we'll run through a couple of things here, but let's go to the next slide. So one, like I would call it a strategy, part and parcel of our overall philosophy, but diversification is important because you never necessarily know where the driver of returns are going to come from, but we also know that being overly concentrated creates risk. So
that's a really good point that I forgot to comment on, and I thank you for bringing that out because that's a risk that also, again, back to the planning process, can be dealt with. Just have to start with awareness. And a lot of times the biases that get in the way here, over concentration often happens out of loyalty to the thing we're concentrated in. And so, and we have a familiarity bias, and we, as a result of that, tend to think, well, we know that company, that's why we have, or whatever that is, we know that, and that's why we're in it. And that over concentration tend to come from some overconfidence, which is another bias that we want to mitigate against. So thanks for bringing that up.
Want to be diversified across different return streams. So capital appreciation is one aspect, but conversely, we don't want to be overly fixated on just dividends per se, or just interest from bonds. And so just like you would diversify stocks and bonds, you want to try and diversify the return streams too, because not everything moves at the same time or grows at the same time. And then as we'll show on kind of the next slides, making sure that everything is well integrated together. Again, back to that philosophy of having a smart place to pull from. This illustration shows kind of a bucketing strategy in taking place. And for each client, it's a little bit different. But a few key tenets or concepts that are important are, of course, you want to have things like cash and short-term bonds, things that are safe on hand, so that if, say, markets pull back over the next 3-6 months, probably minimum, maybe even a year plus or so, depending on your particular risk tolerance, we want to be able to pull easily accessible money to spend so we don't have to sell stocks at an artificially low price. Beyond that, thinking about things like the broader tax strategies many clients may have, or just efficient ways to spend money. So looking at the invested taxable accounts. Depending on time horizon, taking on more risk, owning stocks can make sense. You can sell at long-term capital gains that's favorable compared to the ordinary income rates from pulling money from a traditional IRA. But often clients want some sort of stability too, given especially the early years of retirement where there may be the go-go years, spending a lot in retirement, maybe funding Roth conversion tax bills and the like. That may call for a healthier allocation to bonds in that taxable account, because that's what we want to spend first in those early years. then that allows us to take a longer term approach with some of those traditional IRA balances, growing tax deferred. We may be working to optimize the mix, again, strategic Roth conversion tax strategies, things like that, but shelter investments in there that maybe have more income or maybe some of your taxable bond exposure there so that it is driving up your tax bill in a taxable account. And
Well,
then,
and the thing about that you're saying, Adam, that I think everybody probably realizes, but just in case they don't, the thing about tax strategies is they don't rely on the markets to work. I
right.
mean, so you actually don't have to have the market go up for the strategy to work. And that's an important piece. So you get some absolute things can happen with the right tax strategies, and that all relates to the planning. So I appreciate you
Yeah.
calling that out.
In some cases, the market going down can be the best thing for your tax
Oh,
strategy.
yes.
And
Yeah.
so,
Well,
in the
Well,
case
a
of
lot of times, and this is an interesting time to address this. My dad's long ago passed away, but one of the things that would happen, and he would be talking to his buddies, and the markets would go up and down like they do. And typically, a lot of times, people in retirement that we was hanging out with, he'd get together with them, and they would say, "Oh, gee, I lost a lot of money today." And then he would say, "Well, did you sell any of your shares?" They said, "No." Then he said, "Well, then you didn't lose any money."
right,
So you don't actually lose the money until you liquidate at the wrong time. And and of course have the wrong investment. But that's where the planning comes in that you guys are so gifted and good at. So thank you.
and so like to kind of tie it
Other
out, those traditional IRA balances fall. Great time to maybe convert to Roth, which is growing tax free long term. Recovery takes place within that Roth IRA bucket where there's high growth assets growing tax free. You make more money through an after tax lens. And so as a team, we're integrating all of these different buckets, so to speak, into an overall risk framework that's tied out with the actual financial plan for our clients. The next slide, I would say, really quickly speaks to flexibility. You're not forced to take out the same amount of money all the time either. And so the benefit of planning is you can adjust the plan along the way. And so some years where things are going really, really well, maybe you spend more than normal because you should. You want to enjoy your retirement. Other times it may be more prudent to say, hey, the market's been weak for a little bit of time. Maybe we dial back a few things, a few expenses, and we fund those when the market's recovered. And so being,
well, and what you
flexible
just said
and
is so
flexible.
critical. I love what you just said, Adam, and it is you said when things are good, it's okay to spend some of that. And sometimes people get afraid that they'll miss out on the peak. Don't worry about the peak. Worry about your return on life. Are you getting the return on life that you want? And going ahead and taking some money out at a profit can give you an opportunity to enjoy some of your money. So that's a really good point. Thank you for sharing that as well.
And then I think the third, if we flip to the next one, really kind of comes down to being strategic around back to where you put certain investments in certain account types. And so, again, a simplistic example, but it just goes to show in this one. So you can compare two portfolios. Both portfolios are 50% stock and 50% bonds overall. And many clients have seen this before, and if not, it's a great refresher or a great lesson. But say you have half of your money in a traditional IRA, half your money in a Roth IRA, and keep this very simple from a math perspective. We can make assumptions around how much a stock can grow, how much a bond can grow, the tax rate we pay on that. But that allows you to run some scenarios where we can say in a baseline where the same portfolio is in both accounts, both get a 6.25% return in this example. The difference is the after tax numbers. The traditional IRA has a 24% federal tax being pulled out of it. Roth IRA is tax free. Together, that relationship gets, again, a 6.25% return overall, but the after tax return, the one you actually get to spend, is only 5.5%. Conversely, if we're strategic about this, we don't have to outsmart the market at all. We just change where we put certain investments. And so put the stocks in the Roth IRA to maximize the benefit of long-term tax-free growth. keep that full 9% in your pocket because it's after tax. It's a tax-free bucket. The traditional IRA, though, gets the slower growth assets. In this example, 3.5% return maybe for the bonds, after tax 2.66. Same portfolio overall gets a 6.25% return like in the original scenario. The difference is the after tax return is 5.83%. And so numbers aren't guaranteed, but it just goes to show
Right.
if you get the right investments in the right buckets, all else being equal, and the market plays out in this manner, you can see a clear path to gain an extra 0.33% in your portfolio after tax. And that's something
Yeah.
everybody should be seeking to do without taking on more risk.
Yeah, it leaves it to your point. It's the same portfolio, just performing at 0.33 better for you net net. I think that's really powerful. And I know we're running out of time, and we always do. We have really a lot of stuff that I've got so many questions. Once I get to hear from you, it always makes me think of other things. Um, and so I'm going to cut down here to this. Um, for retirees right now, what are some of the key messages that we want to leave with them? I mean,
Yeah.
so that they're walking out of here today saying, okay, I here's 2026. It's the end of February. We got 10 months left. Here are some
Yeah.
key takeaways. What do you think?
Yeah, I think working with your team, the advisors, I mean, a few things to hit on in this sort of lightning round are, making sure we're striking the right balance between growth and income. Know that where we're pulling from the next dollar from, that's planned well ahead of time and it's protected in a sense. Many clients they have not just portfolios to draw upon, but things like Social Security, maybe pensions. Make sure that's all incorporated and it is within the plan. So just make sure the plan's up to date. And then, of course, being more flexible than overly, I think, rigid or prescriptive is always good. It's good to have guardrails and process in place to overcome emotion and investment biases. But there is an element of flexibility that is necessary to make sure we have the most rewarding retirements that we can.
By
Um,
the way, investor, everybody out there should pay attention to this part. What Adam is saying is really important. We at the Mather Group are paying very close attention to the role emotions play in investor decisions and and how that in turn has historically adverse affected performance. So one of the things you're getting from the Mather Group are people who care about that, understand that, and that's why you're hearing Adam use words like biases, emotions. Those all come into play. One might think they wouldn't, but of course they do. So thank you for saying that. And
and so
then
I think,
you hit some others. What else did you have?
yeah, so I think, and then there were the other kind of questions top of mind. But again, can't solve all these or answer all these necessarily here. But again, on the next slide or two, I think we're just trying to show, the importance of accounting for the eventual volatility that arises in the market. It's we can't avoid it, so we need to prepare for it. Same time, thinking about the overall plan, are the withdrawals and the things we have scheduled upcoming, accounting for taxes, the risk of inflation out there. There's multiple dimensions to all of this. And as part of that, back to that smart money moves philosophy, do we have guardrails or buffers in place where we can ride out the storm, not sell assets at the wrong time, plan well ahead of it so we're not forced into a corner, so to speak. And if we do all of that, volatility it's an annoyance maybe, but it's not something that gets a plan off track. And in fact, could actually lead to opportunities that wouldn't otherwise be there as long as we are prepared for them.
I love it. I think we've hit some great home runs. We'll go with home runs, not just some hits. And this one of the things that's been said, I'm going to say it again. You said it. It's retirement income planning is not about predicting the future. It's about being prepared. It's being prepared with a plan based on all these things that can happen. And volatility is manageable, provided you do the smart money philosophy approach that you're taking. So I love it. It's about stability, flexibility, all those wonderful things. So Adam, thank you for joining me in sharing our thinking with all of our clients and those of you who are joining us for the first time, thank you. Come back. Those of you who are attending and have not yet talked to an advisor, I believe we have some people willing to do that. Is that what you understand too, Adam? So we
Absolutely.
will take your call. So
Yeah.
thank you so very much.
Yeah. Thank you.